Quick test. If a raise pushes you into a higher tax bracket, can it actually shrink your paycheck? Most people answer yes. Payroll offices hear it constantly. Workers turning down raises, refusing overtime, protecting their bracket. The answer is no. It has always been no. And the reason is a machine almost nobody has ever seen drawn out. In the next 20 minutes, how tax brackets actually work, as a staircase, not a trapdoor. Why your real tax rate is embarrassingly lower than the bracket you're quote-unquote in. Where the rest of your paycheck actually goes. The 2 levers that legally shrink the bill, and 5 myths that move real money in the wrong direction. Let's open it up. Here's the picture most people carry around. Tax brackets are boxes. You're in the 22% box, so the government takes 22% of everything you make. Cross a line and your entire income gets taxed at the higher rate. That picture is wrong. Not slightly wrong. Completely wrong. The real system is a staircase of buckets. Your taxable income pours in from the top and fills the first bucket. Only when that bucket is completely full does money spill over into the second, slightly more expensive bucket. Then the third. Each bucket taxes only the money sitting inside it. Nothing else. These are the actual buckets for 2026 for a single filer. 10% on your first $12,400 of taxable income, 12% up to $50,400, 22% up to $105,700, then 24, 32, 35, and the famous 37% touches only income past $640,000. One clarification before we go further. Those bucket edges measure taxable income, not your salary. A $60,000 salary does not put you in the 22% bucket. And in the next chapter, you'll see exactly why the difference is bigger than you think. Notice what this design means. A person earning $1 million pays exactly the same tax as you on their first $50,000. The staircase is identical for everyone who files the same way. Higher earners simply have money sitting in more of the expensive buckets at the top. Economists call this a progressive system, and the rate on your top bucket is your marginal rate. Marginal is just economists speak for on the next dollar. Keep that word. It's about to save someone's raise. Let's kill the raise myth in one picture. Say your taxable income is exactly $50,400, the brim of the 12% bucket. Your boss hands you a $1,000 raise. Does the 22% bucket swallow your whole income? No, only the new $1,000 lands there. You pay $220 on it. You keep $780. A raise can never, mathematically never, reduce your federal take-home pay. Every person who refused a raise to stay in a lower bracket burned free money to escape a monster that does not exist. The same picture rescues overtime and side income, by the way. Extra earnings land on top of your stack, taxed at your marginal rate. They never reprice the dollars underneath. Working an extra shift always leaves you with more money than not working it. Always has. By the way, this staircase is old, and it has been rebuilt many times. The first version, in 1913, topped out at 7%. During World War II, the top step hit 94. Today it's 37. The numbers change with every era. The staircase shape has survived them all. One more piece of the frame. The staircase comes in different widths. Single. Married filing jointly, where the buckets are roughly twice as wide. Head of household, in between. Same shape, different widths. And that bracket everyone talks about being in. Hold on, because it's not even your real tax rate. First, a vocabulary trick the whole system depends on. The staircase never sees your salary. It sees your taxable income, what's left after deductions. Gross is what you earn. Taxable is what the buckets tax. Confusing the two is where most bad tax math begins. Because before your income touches any bucket, the government waves a chunk of it straight through, untaxed. It's called the standard deduction. In 2006, $16,100 for a single filer. Think of it as bucket 0, the free one. Everyone gets it automatically, no paperwork beyond filing. Bucket 0 alone explains a small mystery millions of students experience. Work a summer job, see taxes withheld, then get it all back in spring. If your whole year's income fits inside $16,100, your federal income tax is zero, and every withheld dollar comes home. Let's bring back Maya, our case study from the 401k episode. She earns $60,000. Subtract the standard deduction. Only $43,900 is taxable. Follow that number, because it means Maya never even reaches the 22% bucket. Her top bucket is 12. Now pour her $43,900 down the staircase, bucket by bucket. The first $12,400 taxed at 10%, $1,240. The remaining $31,500 sites in the 12% bucket, $3,780. Total federal income tax, $5,020. And now the number almost nobody computes, $5,020, divided by her actual $60,000 salary, about 8.4%. Maya is in the 12% bracket. Her real effective federal income tax rate is 8.4. Zoom out, and the entire federal income tax is 4 arrows. Salary minus deductions equals taxable income. Taxable income poured down the staircase equals tax. Tax divided by salary equals your effective rate. Everything else, every form, every rule, is decoration on those 4 arrows. And for couples, married filing jointly doubles the bucket widths and the standard deduction. A couple earning $120,000 together, double Maya, lands at the same 8.4% effective rate she has. Double the income, double wide staircase, identical experience. Does the gap survive higher up the staircase? Maya's co-worker Dan earns $95,000. After the standard deduction, $78,900 taxable. He is deep in the 22% bracket. His bill, $12,070. Against his real salary, an effective rate of 12.7%. In the 22 bracket, paying under 13. This is the single most useful sentence in this episode. Your bracket is the price of your last dollar, never the price of all your dollars. Say it at a dinner party and watch someone's entire financial anxiety visibly deflate. But wait, if Maya's real rate is 8.4%, why does her paycheck feel so much lighter than that? Because the income tax staircase is not the only hand reaching into the envelope. Time for a paycheck autopsy. Cut a paycheck open and you find not one tax, but 3. Federal income tax, the staircase we just built, and 2 flat taxes almost nobody can name, packaged together as FICA, Social Security, and Medicare. Social Security takes a flat 6.2% of your wages, up to a cap. In 2026, the meter stops running after $184,500 of income. Medicare takes 1.45% with no cap at all. No staircase, no standard deduction, first dollar to last. For Maya, FICA means another $4,590 a year. And here's a detail even accountants' friends don't know. Her employer pays the same amounts again on her behalf, on top of her salary, 6.2 and 1.45 twice. Half of it just never appears on her stub. A quick aside for freelancers and side hustlers. With no employer in the picture, you pay both halves of FICA yourself, 15.3% called self-employment tax, and instead of withholding, you send the IRS estimated payments 4 times a year. Same machine, manual transmission. Then, depending on where she lives, a third layer, state income tax. It ranges from 0, Texas, Florida, and a handful of others charge nothing on wages, to over 10% in the most expensive states. Same federal staircase everywhere. The state floor underneath it varies wildly. Now for the part that confuses everyone in April. The money leaving your paycheck all year is not your tax bill. It's withholding, a running prepayment your employer estimates from a form you barely remember signing, the W-4. In spring, you file a tax return. That's not a punishment ritual. It's a reconciliation. The real bill, computed on the staircase minus everything you already prepaid. Prepaid too much? Refund. Too little? You owe the difference. That is the entire mystery of tax season, solved. The calendar, since we're here. The tax year closes December 31st, and the reconciliation is due in mid-April. One rule worth engraving: file on time even if you can't pay. The penalty for not filing runs about 10 times harsher than the penalty for not paying. The IRS forgives slow money far more easily than silence. Read the refund line again. A refund means you overpaid every single month, all year. It's not a gift from the government. It's your own money coming home after an interest-free year in someone else's pocket. Hold that thought. It returns in the Myths chapter. So, the staircase sets the bill. FICA takes its flat cut, withholding prepays it all. Which leaves the only question that actually matters: can you make the bill itself legally smaller? There are exactly 2 levers, and most people confuse them for their entire lives. Lever 1. The deduction. A deduction shrinks the income that enters the staircase. It doesn't hand you cash. It makes part of your money invisible to tax, which means its value depends on your top bucket. For Maya, in the 12% bucket, a $1,000 deduction saves $120. Lever 2. The credit. A credit ignores the staircase entirely and cuts the final bill, dollar for dollar. A $1,000 credit saves exactly $1,000, whether your top bucket is 10% or 37%. Same sticker price, wildly different value. This is why a headline shouting new $2,000 tax break means nothing until you know which lever it is. As a rule of thumb, credits punch harder, and some, the refundable kind, can even push your bill below zero. Where do deductions come from? Everyone gets the standard deduction, automatically. And roughly 9 out of 10 filers simply take it and move on. Itemizing, listing out mortgage interest, large donations, big medical bills, only wins when those add up to more than your standard amount. For most people, most years, they don't. And remember the 401k machine from our last episode. Every dollar Maya contributes is income the staircase never sees, a deduction that stacks on top of the standard one and builds her retirement at the same time. The machines connect. They always do. The 401k belongs to a whole family of deductions that work even if you never itemize, the above-the-line kind. Traditional IRA contributions, health savings account deposits, student loan interest up to a limit. Each one quietly shrinks the income your staircase ever sees, on top of the standard deduction. Credits, meanwhile, usually attached to life situations, raising children, paying for education, certain energy upgrades. Their names and amounts get rewritten every few years by Congress, which is exactly why knowing the lever matters more than memorizing any list of programs. And one lever hides in plain sight, the W-4 itself. Marriage, a child, a second job, a big side income. Each one changes what your withholding should be. Update the form when life changes and April becomes a non-event instead of a surprise. It takes 10 minutes on your HR portal. 2 levers, 1 staircase, 3 taxes. You now understand more about your own paycheck than most adults ever will. Time to stress test that understanding against the 5 myths that quietly move real money in the wrong direction every single year. Myth 1. The classic. A raise can cost you money. You've seen the staircase. Only the new dollars climb into the higher bucket. Every dollar below keeps its old price. Verdict: mathematically impossible. Never refuse a raise, a promotion, or overtime to protect a bracket. Myth 2. Bonuses get taxed at a brutal special rate. Here's what actually happens. Employers withhold a flat 22% from bonuses as a prepayment. That's an IRS convenience rule, not a tax. The bonus itself is ordinary income on your ordinary staircase. If 22% was too much for your buckets, the extra comes back at filing time. Myth 3. A big refund means I won. You know better now. A $5,000 refund is a $5,000 interest-free loan you handed the government in 12 monthly installments. The winning move is a refund near zero. Your money in your months. If your refunds are huge every year, your W-4 is quietly misconfigured. Myth 4. I'm in the 22% bracket, so I lose 22% of my income. You watched Dan. 22% bracket. 12.7 effective. The bracket prices your last dollar. Your effective rate, total tax over total income, is the only number that describes your life. And myth 5. These numbers are forever. The bucket edges, the standard deduction, the Social Security cap. The IRS reinflates all of them every autumn, and Congress redraws the staircase itself every few years. The shape is permanent. The numbers are not. Everything you saw today is the 2026 set. Bonus rapid-fire round. If I'm owed a refund, filing is optional. Above the income thresholds you generally must file, and unclaimed refunds expire after 3 years. Gone forever. The IRS just called me angry. The real IRS opens with letters, never with threatening phone calls. That call is a scammer. Hang up. 5 myths. And notice what killed every single one of them. Just being able to see the staircase. That was the entire point of this episode. The whole system. One screen. Tax brackets are a staircase. Only your top slice pays your top rate. Your effective rate sits far below your bracket. Your paycheck carries 3 taxes, not 1. Deductions shrink what the staircase sees, credits cut the bill directly. And a big refund isn't a bonus, it's a loan you never had to give. Your 5-minute action for today. Pull up your last pay stub. Find the federal income tax withheld, divide it by your gross pay. That's your withholding rate. Now compute what we computed for Maya and compare. Most people discover they've been afraid of a much smaller number than they thought. This channel opens up money machines one by one in plain English. Last time, the 401k. Next time, credit scores, the 3-digit number that quietly prices everything you'll ever borrow, and the machine that computes it. If the staircase finally clicked for you, subscribe and send this to the one person you know who still fears their raise. See you inside the next machine.